So there's reason to think we could still bounce back, turn the monthly candle green, and finish the year with a new monthly high for spot gold, a new quarterly high, a new annual yearly high. And all of those things combined to turn the generalists onto the sector. I remember when this happened only once before in the 13 years I've been doing this, was at the end of 2010. And then what happened? The first 8 months of 2011, gold rallied about 25%.
This is Kaiser Johnson, and these are the Miles Franklin Weekly Specials for December 18th through December 25th, 2023, while supplies last. First, we feature 1 10th-ounce gold maples at just $30 over melt with a minimum order of 5. Next, we have silver eagles at $4.99 over spot, making this a great time to swap silver bars into silver eagles at the lowest premium in years. Finally, constitutional 90% silver is just $3 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Craig Hemke from TF Metals Report. Craig, thank you so much for joining us today.
Merry Christmas, Elijah.
Yeah, Merry Christmas to you as well. It's great to have you as the year is coming to an end here. I wanted to get your final perspective on 2023 as we look into 2024. One of the things that is new from the last time we talked is we had the Fed meeting and they held interest rates steady, and the market took what Powell said is very dovish and suggesting there could be rate hikes in 2024. Your perspective on this latest Fed meeting?
Well, it's interesting. I've been expecting this all year long. I write a forecast in the first week of January every year, mainly just to hold myself accountable and to get everything down in writing so that I can clearly recall what I was thinking as the year began. And then, oh yeah, that didn't quite work out, or maybe, that something did. And I thought the Fed would be kind of trapped like they were in 2018, with liquidity drying up. The 10-year note got over 3%. The stock market started to go down back in 2018. I thought that's probably about as far as they could push it this year, too. And so I thought by mid to late summer, we'd be having the discussions that we're having now about, the Fed, inflation's gone. The Fed's going to want to start cutting. It's going to be an election year, all that stuff. It seems like I got about 6 months too early with that. I think what I missed and underestimated the importance of was this $2.4 trillion that ended up flowing into that Fed's reverse repo facility, which is kind of called excess reserves. And it's basically dollars that were created coming out of COVID that got quarantined for a while at the Fed. And I think that, again, that peaked earlier this year at about $2.3 trillion. It's now down to about $700 billion. And trending towards zero probably sometime in the first quarter. And I think that extra liquidity, so about 1.6 trillion or so, is what allowed the Fed to kind of play this game of higher for longer. And to their benefit, I suppose, because it really did drown out at least CPI inflation. And so now that that's going away and the economy is demonstrably slowing, and it's going to be more so in the first quarter, I think we're right on track for the 3 rate cuts, at least, that the Fed is promising next year in their own projections. And we're on track to hit my 2023 goals probably sometime in the first half of next year. At least it looks that way right now.
It does seem like strength we're seeing in the precious metals. I know we did see a pullback after that big rally in gold that Sunday night a few weeks ago into the $2,100 area. But we're still above $2,000 an ounce. We just dipped below it. Your perspective on the current state of the metals markets, and it sounds like in the first quarter of 2024, you're still looking for good news in the metals.
Yeah, that breakout that we've been waiting for the last 3.5 years. It's funny. There are, I don't know, I guess technical analysts, people that are permanently bearish on gold that sit there and they go, oh, look, it's a double top, it's a triple top, it's a quadruple top. look, there's no such thing. I mean, there's a double top, there are double bottoms. Everything after that, you're just in a trading range. And gold has been in this range since, I don't know, August or September of 2020. I mean, clearly defined. It started out right at the end of November, at which point every short contract ever created was underwater at the close on Friday, December the 1st. So it's no surprise that it shot higher and then went right back down, creating that kind of ugly reversal candle. But I do think we are poised to eventually break out on a permanent basis. And when that happens, typically, again, in anything that's been a trading range, it generates headlines. Gold will generate its own headlines. Oh, look at gold now, above 2,100. And you'll get another rush of speculative money. Not maybe, we won't go to 2,300 in a matter of days, but over a course of a couple of weeks, we probably will. And that's what I thought would happen at some time before the end of this year. And so since we're about 6 months behind schedule, I feel comfortable thinking that's going to happen sometime, before summer of next year. Now, it'll be interesting to see where we go from there. And I haven't fully thought that through yet. But anyway, back to the metals and where they are. As you and I speak, gold is up about 11% year to date. Anybody can cherry pick, date ranges. But if we just go back to 2000, this century, on average, dollar price gold gains about 9.3% a year. So, okay, we've had a slightly better than average at this point. The thing to watch, though, now, as we go into the last, what do we have left? 7 or 8 trading days, maybe? Maybe not even that many, 6. Anyway, the thing to watch, at the monthly close last day of November, gold price, the spot gold price, closed above $2,000 for the first time ever. Okay, that was pretty remarkable. And as I said, the very next day was Friday, December the 1st. The daily and the weekly chart closed at its highest price ever. December, typically pretty strong month seasonally for a number of reasons, which we can get into if you want or not. Just to understand it typically is. This is a very strong time, December into January, seasonally for gold prices. So there's reason to think we could still bounce back, turn the monthly candle green, and finish the year with a new monthly high for spot gold, a new quarterly high, a new annual yearly high, closing high for gold. And all of those things combine to turn the generalists onto the sector. I remember when this happened only once before in the 13 years I've been doing this, was at the end of 2010. Gold wrapped up, whether it was New Year's Eve or whatever day it was, on 2010. Gold finished that year, daily, weekly, monthly, quarterly high, higher than it's ever been. And I called it a superfecta, for people that are horse racing fans. And then what happened? The first 8 months of 2011, gold rallied about 25%, as this kind of general rush of funds came in. So let's watch that spot price, that gold price over the next 5 or 6 days, see where we finish up at the end of the year. And that might tell us a lot about where we're going the first half of 24.
How significant do you think was that close back in at the end of November?
Well, it got a lot of attention, right? Even Barron's Magazine, which comes out on the weekend, got note of it. I mean, when was the last time we had mainstream financial press about gold making new highs, Elijah? And that weekend of the 2nd and the 3rd of December, 3 weeks ago, they said, hey, don't even worry about buying gold. Buy some of these mining shares. So there was that little inkling of, we just roughly call it the generalist money, is just a sign of what I think could be to come. When you look at those longer term charts, I mean, I'll sit here and I'll watch the intraday chart, the daily chart, and if you can close above this level and stay above the 50-day moving average and all that stuff is important. But the bigger money, not just, little old me, the people that run the hedge funds, that run the big family offices, the people that manage billions and billions of dollars, mostly have no gold exposure at all and no exposure to mining sector either. But when it goes out, you start making on the longer term charts, these new high, all-time highs. That's what gets people's attention. The short term can, like you said, can go up and down. You get an ugly candle on the chart back on the 4th. That kind of kills incentive for a while. But longer term stuff, is what causes somebody that manages $5 billion to go, look at that gold, man. That's really breaking out. It's been consolidating for 3 years and now it's breaking out. Maybe I ought to take, $10 million, $20 million and allocate it toward gold for the first time. That's the kind of thing. And so that's why, again, let's watch what is the weekly, monthly, quarterly, and annual close that's coming up here in a few days.
Now, when it comes to the stock market, I know last time we had you on, you said that a Fed reversal would be very bullish for the stock market as well. And that seems like what we've seen over the last week or so. We've seen a rally in the stock market, the Dow at all-time highs, other indices nearing all-time highs here as we record on Tuesday. Your perspective on that and going into 2024, I know I talked with Christopher Mullen about this, and he said it's a very risky play right now, the stock market. But your perspective on that, is the stock market a good play right now?
Chris is a friend, and he does great work. But he, too, is kind of short-term oriented. I mean, he's got his list of, 40 different asset classes, and he's constantly looking for whatever is the hottest area right then, and he does a great job. From a longer-term perspective, though, and you and I have discussed this before this year. We're on the verge of that what people used to call the crack up boom, where the central banks, most notably the Fed, have to just keep printing so much money to keep the plate spinning. I mean, it costs $1 trillion now a year just to service the existing net U.S. federal debt. So they have to keep printing money. And when that reverse repo thing runs out, where's the liquidity going to come from? I mean, they're going to have to keep printing the cash. That cash ultimately flows into, investment assets, risk assets. Go back and look, some of the best performing stock markets in history have come in hyperinflationary, the central bank is just printing cash like crazy. So there's always short-term risks and pullbacks. But I've been in that camp now, this crack up boom, for about a year and a half. And again, that's where it looks like we're headed. You and I have probably also discussed that as long as the biggest fear in the stock market is not the fear of losing money, it's the fear of missing out. As long as that stays the same, then dips are going to be bought, regardless of the valuations, and the PE ratios and all that kind of stuff. So I think it's likely, again, stock market, maybe it'll go up a double top at the old highs from 2 years ago. But man, if it blasts right through there, going to generate a lot of headlines like we're talking about with gold. So there's probably room to maintain an allocation toward equities in general. But again, it's not going to be just a straight up ride. There's always going to be sharp rallies and sharp pullbacks.
And it seems like if 2024, the big story is going to be rate cuts, do you see, because a lot of people have been looking for a stock market crash and we haven't seen it. We've seen a major pullback in 2022. And I guess you could call that a crash depending on your definition. But do you expect a stock market crash in 2024, or would that be farther down the line?
Dude, I'm the last guy to ask. I mean, I didn't think we'd make it out of 2011. Or 2012, and here comes, 2015, everything looked like heck. And yet it keeps on chugging higher. Again, just because there's just so much cash that's being created in this debt-based system that all these things have a bid, and it keeps chugging higher. Again, just like anything, I think you'd be foolish. You don't want to have all your money in gold either. You'd be foolish to be 100% allocated, to any certain sector or any certain market. But you look at the environment in this next year, and you'd say, well, traditionally, if we're going into a recession, which I think we are, because of the lagging effects of all these rate hikes, but if we're going into a recession, you'd look at that and go, well, okay, earnings are going to come down and PE ratio should fall and all that stuff that I learned about 30 some odd years ago when I became a stockbroker. But now it doesn't matter. You buy it because it's going up. Look, it's a pullback by the dip. And you get the market driven by those 7 or 8 stocks. Another historical analogy, though, Elijah, we talk about crack up boom, and you and I have discussed when money dies and, the parallels to Weimar Germany and all that kind of stuff. There are a lot of parallels to the late 70s now, too. Inflation goes up and then comes back down and then soars in the late 70s. The gold price goes up, comes back down and soars. The late 70s were kind of defined in the stock market by what was called the Nifty 50. You didn't need to buy all the stocks, just buy the Nifty 50. And, it was the first kind of, in a way, kind of like the first ETF idea. Well, now again, similar history rhymes. They got this magnificent seven of the 7 big stocks that are driving all the gains. Again, it's very similar to where we were in the 70s. And so I would suspect, again, stock market will continue upward, not in a straight line, not without volatility, but I'm not expecting a crash either.
I guess it could be a situation where, getting back to the slogan of your website, watching the end of this great Keynesian experiment, is if the dollar falls, but stocks rally a little bit or stay at the same level, then the stock market it's kind of like a silent crash in some respect, where we could go into a situation where gold is rallying, the stock market is rallying or staying constant, but those numbers are distorted by the fact that the dollar is falling.
Right. You're kind of talking about real returns there, that you're losing purchasing power faster than the stock market's going up. And that's always something, people should keep in mind when they look at any investment. I mean, you could certainly say silver hasn't helped us much in the last 10 years in terms of maintaining, real returns. But so that's always something you want to keep in mind. Inflation is probably here to stay, no matter how you measure it. And to a great extent, the Fed needs that. When we got to a massive, 125% debt to GDP ratio coming out of World War II, and the Fed managed that back down by, sharply negative real interest rates and printing a lot of cash so that you're paying off yesterday's debt with the devalued dollars of tomorrow. And they're going to continue and even put more effort into playing that game going forward. Because, again, can't emphasize enough. I mean, we're at, with the 10-year Treasury at 4% or whatever it is after peaking at 5%, and the 2-year notes, still up there at 4.5%. I think even just in the next 90 days, we have some $6 trillion worth of bills and notes and bonds that are either being issued brand new or are coming due and having to be, pay off the old holders and issue new ones. There's $6 trillion worth, so somebody's got to buy that stuff. I mean, that's how that reverse repo has been drawn down. That cash has come out, gone into the bond market, to hold rates steady and drop it back down. But at some point, someone's got to buy that stuff because we cannot afford to have no bids and all of a sudden Treasury's yielding 6 or 7% because the interest on the national debt is already at $1 trillion. We're at 34 some odd $1 trillion total debt. The rates double from here without the debt even going up. We're talking $2 trillion. Well, and now, I mean, the deficit's never coming down again. The whole thing spirals out of control in the end of that Keynesian experiment that we're talking about. So I feel very comfortable, as you can tell, in projecting where the Fed is going with all this. They've proven since the paradigm changed in 2009 that that's what they will do. They will print and come up with new rescue programs and everything else just to, to keep the plate spinning. And I'm sure that's what they'll do next year, too.
And if our viewers are interested in learning more, they can go to tfmetalsreport.com. I did want to get a bit of a preview here of your 2024 forecast that you'll be publishing shortly here. Can you give us a bit of a preview?
Well, like I said, it's a fun thing. I've been doing the site for about 14 years. I've only been writing these forecasts for about half that time. One, it's an open invitation to get trolled, obviously, because, how are you going to get stuff right? But what I have found selfishly, I do it for me because I want to be able to go back like I can go back now and say, okay, what was I thinking as the year began? What I get right, what I get wrong, and then what I got wrong, try to figure out where I missed it. Like I really thought as this year began, there was a lot of stuff coming out of some of the big investment banks that above ground copper stockpiles were going to be extinguished by like August or September. And all these charts, Goldman Sachs saying that kind of thing. Well, obviously that didn't happen. So, all right. So what I missed there, is that, still a potential driver next year? That sort of thing is what I got to look at. And like I said, I think the thing that I really failed to take into account because it was unprecedented, it hadn't happened before, which is what unprecedented means, was this 2-point-some-odd trillion cash that was just sitting, in this excess reserve account at the Fed. And I failed to take into account the value of that flowing out and supporting the treasury market, supporting the stock market, everything else, and allowing the Fed to, from June to September, play this game that they were going to keep rates higher. Because that's what happened. I mean, sorry, long answer, Elijah, but in June, at the June FOMC, the Fed themselves was projecting 4 rate cuts for 2024. By the September FOMC, they cut it to 2. And it was after that September FOMC that gold dived like 10 days in a row and made its most recent lows. Well, now at the December meeting last week, they're back up to 3. Okay, on average. I mean, their best guesses. So that is changing. And I think now that when that reverse repo trend, goes all the way down to 0 and that bit of liquidity is removed, what's going to have to come from somewhere. That's why the Fed is already talking about cutting rates. And they may very well be discussing some new QE program by summertime, too. Anyway, we talk about this every day. We don't just talk about gold and silver and the chart and this and swing here and pivot there and all that stuff. Try to keep kind of a holistic, big picture stuff. And the community of users, I think, is even more valuable. So come join us. Only $15 a month. Give yourself a Christmas present. I think as we enter the new year, it's money well spent.
All right. Well, it's tfmetalsreport.com. We'll put a link in the description of this video here. Craig, thank you so much for your time today. Merry Christmas and Happy New Year.
Ho, 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 Elijah. We'll see you in 24.
This is Kaiser Johnson, and these are the Miles Franklin Weekly Specials for December 18th through December 25th, 2023, while supplies last. First, we feature 1 10th-ounce gold maples at just $30 over melt with a minimum order of 5. Next, we have Silver Eagles at $4.99 over spot, making this a great time to swap silver bars into Silver Eagles at the lowest premium in years. Finally, Constitutional 90% silver is just $3 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.